Robinhood didn't make investing easier. It made it addictive. Because what started as a simple idea, commission-free trading, ended up pulling millions of people into the stock market faster than ever before. Suddenly, investing wasn't something reserved for Wall Street professionals or people in suits calling their brokers. It was on your phone, one tap away, anytime, anywhere. And for the first time, an entire generation felt like they had cracked the system. No fees, no barriers, no experience needed. Just download the app, deposit some money, and start making trades. And that's exactly what millions of new investors did. During the pandemic alone, Robinhood added over 10 million users. People stuck at home, stimulus checks in their bank accounts, markets crashing and rebounding like never before. It felt like the perfect opportunity to make money. Fast money. Life-changing money. The kind of money you see in screenshots on Twitter and Reddit. And Robinhood made it feel easy. Too easy. Because with a clean interface, instant deposits, and trades that executed in seconds, buying stocks started to feel less like a financial decision and more like pressing a button in a game. There were no confusing charts, no complicated processes, no friction. Just tap, swipe, done. You didn't need to understand the market. You just needed to participate. And that's where things started to change. Because when something that involves real money starts to feel effortless, almost fun, it stops being just an investment tool. It becomes something else entirely, something closer to entertainment, or even worse, a game. Behind the bright interface and the promise of democratizing finance, Robinhood was quietly changing how people interacted with money itself. It wasn't just making investing accessible, it was making it engaging, rewarding, addictive. And the more you used it, the more it pulled you in. More trades, more risk, more time spent chasing the next win. Because underneath all of it was a simple question that most users never stopped to ask. If trading is free, then how is Robinhood making money? And more importantly, what happens when the app designed to help you build wealth starts to behave more like a casino than a brokerage? To understand why Robinhood became so powerful, you first have to understand what investing looked like before it existed. Because for most of history, investing wasn't simple, it wasn't fast, and it definitely wasn't fun. If you wanted to buy a stock, you didn't just open an app and tap a button. You had to go through a broker, a real person who would execute the trade on your behalf. And that process came with friction, a lot of it. Phone calls, delays, paperwork, and most importantly, fees. Every single trade cost money. It wasn't unusual for brokers to charge anywhere from $5 to $10 per trade, sometimes even more, which meant that every decision had weight. Every click, or in this case, every call, had consequences. You didn't casually buy and sell stocks throughout the day. You thought about it. You hesitated. Because even if your trade made no money, you still paid the fee. And that alone created a natural barrier. A barrier that kept a lot of people out of the market entirely. For beginners, it felt intimidating, confusing, almost like a system designed for insiders only. Charts looked complex, terminology sounded like a foreign language, and the idea of losing money on top of paying fees, that was enough to keep most people on the sidelines. Investing, for the average person, was something you either didn't understand or didn't trust. And then Robinhood showed up, with a message that sounded almost too good to be true. Commission-free trading. No fees, no minimums, no barriers. For the first time, anyone with a smartphone could open an account and start investing within minutes. No phone calls, no paperwork, no waiting. Just sign up, deposit money, and trade. It felt like a revolution, a complete shift in how financial markets worked. Robinhood didn't just remove fees, it removed friction. And by doing that, it opened the floodgates. Millions of new users entered the market, many of them young, many of them with zero prior experience. People who had never bought a stock before were suddenly trading daily, because now there was nothing stopping them. No cost to enter, no penalty to try, No reason not to. And on the surface, it looked like a perfect solution. Make investing accessible, level the playing field, give everyone a chance to build wealth. It sounded fair. It sounded empowering. It sounded like progress. But when something in finance feels completely free and completely easy, it's usually worth asking one simple question. What changed, and who is really paying for it? So if trading is free, how is Robinhood actually making money? Because companies don't remove fees out of kindness. They remove them because they found a different way to get paid. And in Robinhood's case, that answer is something called payment for order flow. It sounds complicated, but the idea is simple. Every time you buy or sell a stock on Robinhood, your order doesn't go directly to the stock market. Instead, it gets routed to large trading firms, companies like Citadel Securities. These firms pay Robinhood for the right to execute your trade. In other words, your trade is the product. Robinhood collects millions, sometimes billions of dollars by sending user orders to these firms. And in return, those firms get to process massive volumes of trades, often making small profits on each one. A fraction of a cent here, a tiny spread there. Individually, it's nothing. But at scale, it's huge. Because when millions of users are constantly buying and selling, those tiny profits add up very quickly. And that leads to an important shift in incentives. Traditional brokers used to make money through commissions, so the relationship was simple. You pay, they execute. But Robinhood flipped that model. Now you don't pay to trade, which means you're no longer the customer. You're the product being sold. And the more you trade, the more valuable you become. Because every trade you make is another opportunity for Robinhood to get paid. Not from you directly, but from the firms on the other side of your order. Which raises a critical question. If a platform makes more money when you trade more, what kind of behavior is it going to encourage? Long-term investing? Careful decision-making? Or constant activity? Because from a business perspective, a user who buys one stock and holds it for 10 years is almost worthless. But a user who trades every day, multiple times a day, that user is incredibly profitable. And that's where the real design starts to reveal itself. Robinhood isn't built to slow you down. It's built to keep you moving. More trades, more activity, more engagement. Because behind the clean interface and the promise of free trading is a system where every tap, every swipe, every decision is quietly being monetized. And once you understand that, you start to see the platform very differently. Because at that point, it's no longer just an app that helps you invest. It's an app that makes money when you act. Robinhood didn't just make trading free. It made it addictive. And it did this in a way that's eerily similar to a casino. Open the app for the first time, and you're greeted by a clean, bright interface that feels more like a social app than a trading platform. Nothing clutters the screen. Everything is simple, intuitive, and most importantly, fun. You swipe left or right, tap a button, and suddenly, you've made a trade. It's that easy. No forms, no friction, no waiting for brokers to pick up the phone, no piles of confusing paperwork, just instant action. And every time you do, Robinhood rewards you, literally. When you buy your first stock, colorful confetti bursts across the screen. Little celebratory animations reinforce the behavior. Your brain interprets that as a win, even if the stock immediately drops in value. Every notification ping, every small increase in your portfolio, every achievement notification is designed to give a tiny rush of dopamine. It's the same chemical hit that gamblers feel when the slot machine lights up. Push notifications don't just inform, they manipulate. Your stock is up 3%. Tesla is trending today. Apple is moving. Buy now. These alerts aren't neutral. They're engineered to trigger impulsive action. And because the interface is mobile first, the friction that would normally slow you down in traditional investing is gone. You don't have to log into a complicated broker platform or wait for confirmation. You just swipe and buy. Then there's the allure of options. Suddenly, what used to take years of understanding and careful analysis is presented as a way to make fast money. Leverage, calls, puts, all are laid out in a way that feels simple and accessible, even for beginners. The potential for a big win is right there, highlighted in green, clickable, and ready to reward. Losses? They're abstract. Your screen just updates. There's no pain, no immediate sense of real-world loss, just another number moving somewhere on your phone. The genius, or danger, of Robinhood's design is that it removes the friction from trading and injects dopamine into every step. It turns slow, deliberate investing into rapid, almost reflexive decision-making. Users are encouraged to trade frequently, chase trends, and get that next little rush of excitement. Every swipe, every tap, every notification is engineered to make you feel rewarded regardless of whether your trade was wise. And here's the kicker. In doing this, Robinhood has effectively transformed investing into a game, a casino, and a social experience all at once. People aren't just managing money, they're playing a dopamine-driven system that profits when they act and profits even more when they act impulsively. By removing complexity, hiding risk, and gamifying every interaction, Robinhood created a platform where the traditional tension and careful thought that used to define investing are replaced by instant gratification and addictive feedback loops. In other words, the app didn't make investing easier, it made it addictive, and millions of new investors didn't even realize they were being drawn into a system designed more like a casino than a financial tool. Key takeaway? Robinhood didn't just democratize investing, it removed the friction, amplified the dopamine, and turned your phone into a trading arcade. The gamification of Robinhood didn't just make trading fun, it had real consequences for millions of investors. What started as a convenient way to buy stocks turned into a high-stakes thrill ride, and the numbers showed just how far people were willing to go. Once the friction was removed and dopamine started flowing with every tap, the next step was almost inevitable. People began to trade more frequently. What used to be a deliberate, research-based decision, holding stocks for months or even years, became a series of impulsive clicks. Investors, many with little experience, were now chasing instant gratification. A few dollars gained here, a few dollars lost there, but the volume of trades skyrocketed. And every trade was profitable for Robinhood, thanks to payment for order flow. The more you traded, the more the platform made. And then came the risk escalation. Beginners who had never considered options before suddenly found themselves buying calls, puts, and leveraged positions. Options promised huge returns in short timeframes, and the bright green buttons and easy-to-understand interface masked the reality. You could lose your entire investment in minutes. But the thrill of the gamble, amplified by Robinhood's gamified feedback loops, was hard to resist. People were hooked on the adrenaline. This combination of gamification, ease of access, and zero-commission trading set the stage for viral market phenomena. Enter GameStop. In early 2021, a Reddit community noticed that the heavily shorted stock of a struggling video game retailer was vulnerable to a short squeeze. Ordinary retail investors, many of whom were active Robinhood users, piled in. The stock skyrocketed, then crashed, then soared again, creating a roller coaster of emotions for anyone holding shares. For some, the gains were life-changing. For others, the losses were catastrophic. People who had borrowed money or used margin to buy GameStop shares found themselves in debt, unable to cover their positions. GameStop wasn't an isolated incident. Similar stories unfolded with AMC, BlackBerry, and other heavily hyped meme stocks. Users were trading not because they understood a company's fundamentals, but because of social pressure, FOMO, and the hope of hitting it big, a modern-day lottery mentality. And as the losses mounted, so did the emotional toll. Investors reported sleepless nights, anxiety attacks, and panic selling. Families were affected, savings were depleted, and some people even turned to credit to fund trades. The ultimate truth became clear. This wasn't investing anymore. Buying a stock for its long-term potential had been replaced by chasing short-term thrills, hoping for a hit of dopamine with each rise in price. Options amplified the stakes. The gamified interface encouraged constant action, and social media fueled the hype. The market for these traders had become a casino, and they were sitting at the slot machines. Robinhood had created an environment where rational investing was almost impossible. Users weren't clients, they were players in a system designed to profit from their engagement and risk-taking. And while some walked away with gains, many more were left with the bitter taste of losses and the realization that the app had turned their money into a game. Key takeaway: what started as democratizing investing evolved into a dopamine-driven gamble, where inexperienced investors risked real money for fleeting thrills. Robinhood didn't just change how people invest, it blurred the line between investing and gambling, with consequences that continue to reverberate across the market. By now, it's clear that Robinhood wasn't just an app. It was the spark that ignited a global shift in how people interact with money. The platform showed millions of retail investors that trading could be easy, fast, and most importantly, fun. But as we've seen, fun in this context came with a hidden cost. The lessons of Robinhood ripple far beyond the world of zero-commission stock trading. Fast forward to today, and you can see the same pattern playing out across new financial landscapes. Crypto apps, NFT marketplaces, and even gamified investment platforms are following the playbook Robinhood wrote. Push notifications, flashy graphics, rewards for activity, and instant confirmation of gains and losses, all designed to keep users engaged, clicking, and hoping for the next dopamine hit. Just like Robinhood, these apps make investing feel like a game, with each swipe or tap serving as both an entertainment and a financial decision. It's not limited to stocks anymore. In crypto, the stakes are higher and the volatility is extreme. A token can double in value overnight and collapse just as quickly, leaving inexperienced investors reeling. Yet the interface encourages action, not reflection. The bright green buy buttons, price charts that look like roller coasters, and constant notifications blur the line between trading and playing, between risk management and thrill-seeking. The lesson from Robinhood is clear. When investing is gamified, the odds are subtly stacked against the player. Someone, somewhere, is always profiting from your activity, whether it's the platform itself, market makers, or more experienced investors. This isn't to say that all modern trading is bad, or that Robinhood and its successors don't offer genuine benefits. Accessibility has improved, more people are learning about finance, and democratization has real value. But the design choices, the confetti, the swipe gestures, the instant notifications nudge human behavior in predictable ways. And human behavior is predictable. We chase excitement, we hate missing out, and we underestimate risk. By transforming investing into a game, these platforms exploit that predictability. The final sobering thought is this: when investing feels like a game, you can be sure someone else is playing for keeps. Your wins are someone else's losses, your rapid-fire trades fuel profits for others, and the dopamine highs mask the underlying risk. The thrill of easy gains can blind even the most disciplined investor to the realities of leverage, market volatility, and human psychology. Where Robinhood started, these new platforms continue, a world where entertainment and finance are intertwined, and where the house often has the edge. So before you tap buy on your next stock, crypto token, or meme coin, ask yourself a simple but crucial question. Am I investing or am I playing? The answer determines whether your money is working for you or whether you're just another participant in a system designed to make someone else rich while keeping you addicted to the game. Understanding that line and respecting it might be the most important lesson Robinhood has to offer. In the end, the story of Robinhood isn't just about an app, a trend, or even a generation of retail investors. It's a cautionary tale about human nature, technology, and trust. It's a reminder that while democratizing finance is powerful, gamifying it carries consequences. And it's a question we all need to answer for ourselves. Are we building wealth, or are we simply chasing the thrill?